The market moves. Understanding what really drives the financial markets. Every trader has asked this question at some point. Why does the market move? Many beginners believe that indicators, trading bots, or random price changes move the market. But the truth is much deeper. The market moves because of the continuous battle between buyers and sellers. Every price you see on a chart is the result of millions of buying and selling. Decisions made by retail traders, banks, hedge funds, institutions, companies, and governments. The market has only one job: to find a price where buyers and sellers agree to trade. When that balance changes, price moves. 1. Supply and demand. The first force behind every market movement is supply and demand. When more traders want to buy than sell, demand becomes stronger than supply, and price rises. When more traders want to sell than buy, supply becomes stronger than demand, and price falls. This simple principle is the foundation of every financial market. Whether you trade forex, stocks, cryptocurrencies, or commodities. 2. The psychology of the crowd. Markets are driven by human emotions. The two strongest emotions are fear, greed. Greed causes traders to buy aggressively because they fear missing out on profits. Fear causes traders to sell quickly because they want to avoid losses. These emotions create trends, reversals, breakouts, and sharp market movements. The chart is not just showing prices, it is showing human psychology. 3. Institutions control most of the money. Retail traders make up only a small part of the market. The largest movements are often influenced by institutional participants such as commercial banks, investment banks, hedge funds, asset managers, large corporations, central banks. Because they trade enormous amounts of money, their decisions can create significant price movements. Professional traders pay close attention to where institutional money is likely entering or leaving the market. 4. Liquidity drives price. Liquidity refers to areas where many buy and sell orders are waiting. Large institutions cannot execute massive trades instantly without affecting price. Instead, they often seek out highly liquid areas where many orders exist. This is why price frequently moves toward previous highs, previous lows, major support and resistance levels, psychological price levels. Understanding liquidity helps explain many market moves that appear confusing to beginners. 5. News changes expectations. Economic news can quickly change the market. Examples include interest rate decisions, inflation reports, employment data, GDP releases, central bank speeches. News does not simply move prices because it is announced. It moves prices because it changes traders' expectations about the future. The market is always trying to price in future events. Trends are created by imbalance. An uptrend begins when buyers consistently overpower sellers. A downtrend begins when sellers consistently overpower buyers. A sideways market forms when buying and selling pressure is relatively balanced. Every trend is simply the result of one side becoming stronger than the other. 7. Price leaves clues. Price never moves randomly all the time. Every candle tells a story. Every swing high and swing low represents a battle. Every breakout shows that one side has temporarily gained control. Learning to read these clues is one of the most valuable skills a trader can develop. 8. Successful traders follow the market. Many beginners try to predict every move. Professionals focus on following evidence instead. They ask questions such as, who is in control? Is the trend strong? Where is liquidity? What does price action reveal? Does the current setup fit my trading plan? Trading becomes much clearer when you stop trying to force the market to agree with your opinion. Common mistakes beginners make: trading without a plan, ignoring risk management, overtrading, chasing the market after missing an entry, letting emotions control decisions, believing every indicator gives perfect signals. The real secret: the market is not your enemy. It is not trying to make you lose money. It simply reflects the combined actions of millions of participants around the world. The trader who survives is not the one with the most indicators or the most expensive strategy. The trader who survives is the one who understands how the market moves, protects capital, manages emotions, and remains disciplined over hundreds of trades. Final thought: the market will always move. Sometimes it will trend. Sometimes it will consolidate. Sometimes it will surprise everyone. Your job is not to control the market. Your job is to understand it, respect it, manage your risk, and patiently wait for high-quality opportunities. Master the market's language, and you'll stop chasing price. You'll start understanding it.